Okay, let's go ahead and do a quick slideshow on the installment method where interest is included in the payments. Now, long-term payment plans generally include interest. The installment and cost recovery methods generally involve cases where payments are spread out over a number of periods. If the payments weren't spread out over a number of periods, then there would be no need to allocate the earnings to the different periods as cash is received. And so again, the payments extend out over a number of periods, which means that interest is going to be charged. When credit is extended over several periods, interest is charged, and it's either explicit interest, for example 5% on the unpaid balance, or implicit. Now, we've all seen ads for zero interest financing, whether from car dealers or furniture retailers. But the problem with that is, to get zero interest financing, to compensate for the no interest financing, the sales price of the asset is marked up. So there's no such thing as completely interest-free financing. The interest is either explicitly added to the purchase price, or the purchase price is increased to compensate for the lack of explicit interest. Now, we might have an item with a cash price or a fair value of $10,000. If we sell it with zero interest financing, we'll charge $11,000 or $12,000 for the item in order to compensate for the zero interest loan we're making. We'll revisit this when we talk about capital leases, but basically the present value of the payments to be received, discounted at the market or fair rate of interest, must equal the fair value of the asset. Now, under the installment method or the cost recovery method, we recognize the income or the profit as the sales price is collected. If interest is included in the payments, then we have to be careful to first separate the interest from the principal and then recognize income only in accordance with or in proportion to the principal that's been received or collected. Let's go ahead and do a quick example. Assume that on January 1st, 2015, we sell goods for $10,000, and we're going to collect the sales price in 3 equal annual installments, each payment made December 31st, with payments including 10% interest. Now, the gross profit rate on this sale is 20%. There's a $2,000 gross profit divided by a $10,000 sales price. Now, the first order of business is going to be to compute the amount of the annual payment. Now, we realize this is an annuity, and it's the present value of an annuity problem. So, what equal annual payments discounted at 10% have a present value of $10,000? So, using either our financial calculators or our spreadsheets or our scientific calculators or our tables, somehow or another, we arrive at the determination that the annual payments will be $4,021.15. Now, this number, it passes the sniff test. It's intuitively reasonable. There are going to be 3 payments of about $4,000 each, so total payments will be about $12,063 on a $10,000 sale. So of the $12,000 we receive, $10,000 will be for the sale of the asset itself. The other $2,063 will be for interest, which is again compensation for extending credit over 3 years. First, we record the sale of the asset. So, basic sale on credit. We record the cost of goods sold. And at the end of the period, we close the sales and cost of goods sold to deferred gross profit. So again, instead of closing our revenue and expense income summary, we close them to this deferred gross profit account. When we receive our first payment of $4,021.15, the first order of business is to split it between interest and principal. So again, we receive cash of $4,021. We have a $10,000 receivable, which is bearing interest at 10%. So 10% of $10,000 is $1,000 of interest revenue. The other $3,021 is paying down the receivable itself. So when we go to recognize the gross profit, it's going to be 20% of the sales price, or 20% of the receivable collected, not 20% of the total cash receipts. Again, the total cash received includes interest and principal, and we only recognize gross profit in proportion to the principal received. So again, we received $3,000 of the principal. Based on a 20% gross profit rate, we're going to go ahead and recognize $604.23 of that formerly deferred gross profit. A similar reasoning would take place under the cost recovery method. Again, as we collect the money, we're going to separate it into two sort of mental piles, interest versus principal. We only under the cost recovery method will only recognize the profit after the principal collected exceeds the cost of the merchandise.